Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, January 26, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is the December PC report and more stimulus signals from China offer strong support for Goldilocks. The nuance there is that the December PC report offers strong support for our resilient U.S. economy theme and the immaculate disinflation theme underpinning the current Goldilocks market regime. Elsewhere, Beijing signaled more targeted stimulus via low-cost PBOC funding to specific sectors of the economy. It is clear restoring confidence among investors is core to the Chinese Communist Party's agenda, so investors should continue to expect a front-loading of stimulus in early 2024, which our research accurately presaged in December. Market implications. These signals are supportive of the research conclusions we have espoused in the modal outcome and right tail risk sections of our last few macro scouting reports. Those differentiated insights are why bears have been run over by the current Goldilocks market regime and may be forced into upside capitulation in the coming months. That is, if asset markets can get past next week's gauntlet of critical macro, micro, and policy updates. On the 29th, we're going to get first the quarterly funding announcement, the part one of that. We just get the targets on the 30th. We get the December JOLTS report, Microsoft earnings and Google earnings. On Wednesday, the 31st, we get the QRA part two, which with the composition in terms of bills, bonds, etc. The FOMC's on Wednesday as well as the Q4 employment cost index. On the Thursday, we get the Bank of England and Q4 productivity and unit labor costs. Very important data points there as well. Amazon earnings, Meta earnings on next Thursday as well. And then next Friday, we got January jobs report and Apple earnings. So obviously, about as much critical economic macro and micro information as you could pack into 1 week. If markets can survive that week, we're very much going to be heading into, or not very much going to be, but the probability of persisting in this risk-on Goldilocks regime, or even maybe potentially transitioning to a risk-on reflation regime, that probability would rise if we're going to survive next week. But again, that's a big if. We've got to get the data and continue to be Bayesian and execute our process throughout. And then lastly, commodities appear to be setting up for a bull run. Consult our leadoff morning notes for the past week or so with respect to China, as well as that December 15th leadoff morning note on China for more details regarding that thesis. Transitioning to our 42 macro dashboard here, as always, we'll start with the trading range signals from our friends over at Longbow, getting a near overbought signal in base metals there. It's been a big week for that kind of exposure for Chinese assets, Chinese risk assets, commodities in general, responding to a lot of the stimulus measures that the Beijing continues to send out. We're getting a near overbought signal in the 10-year tip yield right now. What else we getting? Gold's nearly oversold in terms of it's got about $10 a downside in terms of the trading range there for gold. So that's about it in terms of trading range. And then we'll wrap up, as always, with a question from our 42 Macro Aware community. The questions regarding our weather model says, good morning. I was just curious as to the rationale behind the next 12-month Bloomberg estimates as growth and inflation components in the weather model. I asked because from my viewpoint, the person asking the question with no finance background in parentheses, there is a discrepancy in the time frames 12 months versus the weather model 3-month outlook, and also with regard to what you have suggested recently about the limited value of trying to predict future outcomes. So I'll start answering this question by answering the second half of the question first, because I think it's important to clarify. I think I was misquoted here in the question. We think there is a significant amount of value in predicting future outcomes. What we don't think there is significant amount of value is in positioning for those future outcomes the second you generate those predictions. A lot of people do a bunch of research. Oh, I'm bearish now. Let me put on a bunch of short positions. Other people do a bunch of research. Oh, I'm bullish now. Let me put on a bunch of bullish positions. What we do is do bearish research, bullish research, and everything in between every day, every 6 days a week here at 42 Macro. And obviously, our macro scouting report is one of the best monthly slide decks you're going to find on Global Wall Street. And I mean, it's no words about that. We do that research, and then we allow the market signals as dictated by our global macro risk matrix, among our other quantitative risk management signals, to allow us to put those positions on when it's an appropriate time to put those positions on. It's not we're not in the business of picking tops and bottoms in asset markets. We're in the business of identifying and profiting from momentum in asset markets, which obviously means we're never going to sell the top. We're never going to buy the bottom. If you expect us to sell the top and buy the bottom for you, you're going to be severely disappointed. Our research can help you sell the top and help you buy the bottom if you're focused on the right signals from our fundamental research summary, or focused on the right signals from our quantitative risk management summary. A great example of that was the pivot we made in the beginning of November back to the bull side, which actually front ran the phase transition in the global macro risk matrix to a risk on regime. We used our positioning model to front run that signal, which ultimately carried asset markets higher from a regime standpoint. So there is a tremendous amount of value in predicting the future, because ultimately predicting the future allows you to have confidence in the regime. Sort of allows you to have confidence in a variety of manners. The first way which allows you to have confidence is in trying to understand how long the current regime is likely to last or persist in a risk on or risk off condition. And more importantly, at times when you think when other signals suggest that the regime may not last for an extended period of time, it allows you to anticipate what the next regime might be. So at all points in time, our process is designed to A, figure out what the current regime is, and B, figure out what the next regime might be based on the evolution of our fundamental research process and the evolution of our macro weather model signals. Now, getting back to the macro weather model signals and wrapping up with the question, the investor is curious on the rationale behind using the next 12-month Bloomberg estimates for growth and inflation components in the weather model. The rationale for that is twofold. One, we want the weather model to be smart about what other people think in the economy. We don't want the weather model to be smart about what one man thinks, which is Darius Dale. I'm very good at forecasting growth and inflation, but I don't think we should be anchoring an institutional research process on just one man's expectations. This is why we source those Bloomberg consensus estimates for growth, the inflation, unemployment rate, for sales and earnings growth with respect to the equity market, and source those and pull those into the macro weather model, because the consensus over time tends to be more right than the wrong. And so that incorporating that information is very important in terms of the weather model signal. Why the next 12-month time horizon relative to a 3-month time horizon? That's just purely from a model building standpoint. There's a lot less volatility in the next 12-month estimates relative to, let's say, a 3-month estimate. That time series will be a lot more volatile, and thus creating a lot more volatility in the overall signal, and contributing a lot more volatility in the overall signal. So that's just from a econometrician standpoint, it's just better process to have more smooth variables when you're forecasting kind of outcomes in both the economy and asset markets. So we don't have to go down an academic rabbit hole in that, but you can trust that the weather model will continue to do exactly what they've been doing since we introduced that process towards the beginning of last year, which is keep our clients on the right side of macro market risk. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Friday, January 26, 2024. Everyone have a wonderful day out there. Best of luck, and we'll have a great weekend, and we'll catch you back here on Monday. Cheers.